So Zach, we got Nathalie on the line. What do you want to ask her?
As you kind of brand the Nathalie brand and speak with people, you meet people, but you want to have these ongoing touch points. How did you flesh that out? What did that look like for you?
Having the momentum, and I know it doesn't help an early syndicator, but once you have the momentum, you have a natural touch point of a monthly interaction with your investors in terms of updating them on a deal and things like that. The way I've promoted myself is, again, the old-fashioned keep myself in front of people in person. But you do try to be personal, because I would want somebody to know me personally and interact with me that way if I was going to be investing with them.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Bryan Briscoe with Four Oaks Capital. I'm very excited for today's show. It's another one of our Ask the Expert episodes. We have two amazing people on the line with us. We have our experienced investor, Nathalie de Vos Burchart, and our motivated aspiring investor, Zach Bryan. And incidentally, our aspiring investor has more units right now than some of our experienced investors, but we'll get to that later. So Nathalie, you're up first. So first of all, welcome to the show.
Thank you. Thank you, Bryan. Thanks for having me. So you want a little bit of my background, I'm assuming?
Absolutely. Yeah, let's roll right into that.
So like a lot of folks, I have a tech that get interested in apartments. I do have a technical background. My undergrad is in chemical engineering. I have an MBA as well from UT. And actually, I thought about it. I'm wearing my McCombs MBA.
Nice.
Polo today. So there you go.
I'm wearing the polo from my alma mater, which my daughter bought for me. So
yeah. So
in a way, we're matching.
If you don't like burnt orange or you're an Aggie, I apologize ahead of time.
That's all right.
I went to school in St. Louis, and my first job out of school was on the refined products commodity trading floor for ExxonMobil. At the time, largest corporation in the world, was on the trading floor. And then one of the traders and I started bouncing back and forth on a business plan for our own company. Mm-hmm. And in 2006, two of us left ExxonMobil together and started our own refined products trading company called BioUrja. And was doing that for 11 years, grew that up from the ground up. Was two of us for the first 2 years. So all of the operations, finance, everything. If it wasn't on one of our plate, it was on the other. And managing that growth was a big deal. And the way you do apartments is with those loans. Well, for our company, it was large bank lines, and we didn't get a bank line until a couple years into it, and that was just like oxygen for the business. And working with large syndicated bank lines, I've got a lot of experience on that end. So part of that prepared me for apartments. And then my last 2 years at BioUrja was all mergers and acquisitions, where I was valuing the equivalent of apartment complexes in the energy space. So storage facilities, production facilities, pipelines. And the idea was to normalize our financials, because it gets volatile with trading, because you can make your year in a few months and then just sit on your hands the rest of the year. But that doesn't look nice and smooth right. for those banks and those bank lines I was just mentioning. So acquiring more of those cash flowing assets for the business. My last 2 years there, we acquired 6 companies or assets, which meant a lot more that we looked over, due diligence, et cetera. So if you imagine valuing, say, a refinery in Hawaii with crude coming from Asia, forward curves, a whole distribution network with storage facilities and gas stations, it gets a lot more complicated than a 5-tab spreadsheet.
Yeah. I can imagine.
Yeah. But during that time, I was pregnant, had a child, and didn't see him for the first year because I was on the road all the time.
Yeah.
And that we'll get to my why with that. But I already had an interest in apartments, and starting in 2008, 2009, I bought 30 single families in Houston, all in the same zip code, and self-managed that nights and weekends. And between the demanding work at BioUrja, baby on the way, and 30 single family rentals, it was like, what's the best return on time? And that's where, looking at the options in the space, apartments came up as this glaring answer to scaling up and being more efficient with my time.
So a lot to unpack there. And I think your story with BioUrja parallels what a lot of people do in the apartment business. You were working for corporate America and you ended up venturing out on your own. If I could unpack that a little bit, what was going through your mind? What was part of your decision process before deciding, hey, I'm going to leave Exxon, one of the largest companies in the world, or at the time, the largest company in the world, corporate America, to found a company of your own?
So it was too slow. Had I not gone to work for Exxon, I would have done a master's PhD at University of Michigan in environmental engineering. So I wanted to be part of changes on the environmental front. And I thought, okay, largest corporation, that's where it's going to happen. That's where they're going to have the money and the ability to make an impact. But once you get in with all your energy from undergrad, you realize, wait, this is really, really slow. And when the renewable fuel standard RFS came to be law in 2005, 2006, that is the genesis of BioUrja. That is what caused the company to be created. And the leap was an easy one. So you think in trading, you think about whether you're hedged or not. I'm early in my career. I'm leaving on good terms from ExxonMobil. I could always go back. It was a bet on myself where I could control my own destiny. So really, it wasn't even a choice. It was, of course, I was going to do it. And I didn't feel, exposed or like I was taking this big risk. Nobody around me agreed with that. So my parents were like, you don't leave ExxonMobil, you're management track. You're on the 2-year rotation program. What are you thinking? And I was like, I'm going to be able to make decisions, even if there's not as many zeros behind it, management level decisions that I won't get to until the tail end of my career. I'm going to be able to make them now. And it's either I can handle it or I can't, but I want to do it.
Yeah, I love that. There's a lot of good reasons there. A lot of people look at corporate America, climbing that corporate ladder, and you bring up some good points. To get to the top of the corporate ladder, it takes decades. And then I like how you said you bet on yourself. A lot of people will just stick with the corporation for the paycheck. And a lot of people look at that paycheck as stability. And you thought, hey, I'm going to bet on myself. I think I can be in a much better position personally and professionally by betting on myself, which, I wish I would have done earlier, to be honest with you.
Yeah.
So,
no, the paycheck is false security.
It is.
And the sooner you realize that, the better.
Yeah. It took me, 17, 18 years to realize that. And by that time I was really close to retirement. So I just slugged the last 2 out, but it is absolutely false.
And corporate America, you because every time you're going to work, you're looking for that why or what's pushing you. And when you start boiling it down to, okay, it's return to shareholders, it gets a little hard to dig in and be motivated. Whereas if you're building a business and you, in the middle of a slowdown in the economy, you're able to hire people, you're able to grow, you're able to buck trends of what other people are doing. I mean, that's exciting in and of itself. That's a return. It's not a financial one, but it's an exciting growth. I mean, it's one of those things that you look for in terms of life satisfaction, and you have that growth component with a business.
Yeah, absolutely. Absolutely. And, I think a lot of people who are jumping into multifamily have kind of that same realization that you had going from Exxon to BioUrja, but just slightly different. It's like I'm in the corporation. I want to be my own boss. I want to make those decisions. I want to, have the extra flexibility, and the same type of decision process leads a lot of people to multifamily. But so, fast forward, you said 2008, 2009, you bought a 30-something single family in Houston. Great time to buy post crash. I assume that had something to do with when and what you bought.
I was fortunate enough to have liquidity, and that seemed like there was good values. So.
Yeah, I bought one in 2008 after the market crashed, and I wish I would have figured out a way to buy more. That was the, had I a crystal ball at the time, I would have bought as many as I could. But anyway, that said, so you talked a little bit about getting into multifamily, and you kind of brushed upon your why. Let's talk about your big burning why right now.
Well, the reason I left BioUrja and then switched to focusing more intently on apartments was family. So our son was one, and I wanted, again, that return on time, but more of it with a balance. And the fortunate reality is I'd worked too hard and front loaded my life so much that I'd reached a point where I had the luxury of being able to say I've earned the ability to spend a disproportionate amount of my time, even though I'm in my early 30s, with family, and I'm going to make that choice. And I'm not measuring that as a financial return. I'm measuring it as a personal return, and it's worth it to me.
Yeah, definitely.
And since then we also have a daughter. She's now two and a half, almost 3 in December. And healthy, beautiful kids, and I'm involved with dropping them off, picking them up, taking them to their activities, and that's what I want.
Yeah, it's nice. It's nice, and I just left my W-2, and I tell you what, being there when kids leave for school. My wife works at the same school they're at, so I don't take them to school. It's obvious, she does, but there when they leave for work or for school, there when they get home, and taking them to their after school activities. It's something that I didn't have for a long time, and I'm glad I do have it now. And I appreciate what you said there. So
yeah, well, you start counting how many Christmases or holidays you have left with them, and then you go, oh, wait, there's not that much of a window to help put in as much as you can as a parent before they start making their own independent decisions. What made
me jump into multifamily is the opposite, counting how many birthdays, Christmas, and holidays that I missed. And when I realized how many birthdays, Christmases, and holidays that I missed, I realized I have to do something different. I've been gone too long. I've got to do something different. And that's so our whys are very similar. And anyway, I appreciate what you said there. So let's talk a little bit about apartments for a second. Can you give us an idea of the type of stuff you look at? Pick a favorite deal, pick a recent deal, and let us know what's going on.
So I like value add, B and C space, and being in Texas, Houston, and now Fort Worth area. I like that triangle of Dallas, San Antonio, Houston. So I look in those markets. I have passive investments in Houston, and I have been underwriting this year in Houston, but haven't syndicated a deal there. But I've syndicated deals in Dallas and San Antonio.
Nice.
And those have done very well.
Okay.
I've been involved with deals in Oklahoma, and there's a mixed bag there.
Yeah, I mean, it's not every deal. Unfortunately, not every deal does as well as people project. But now you say you're refinancing a deal today, right?
Yes.
Okay.
So we bought a 174 unit deal in South San Antonio, 60s vintage, so an old one. But when I toured that property in late 2000s, so we bought it in 2019. So it was late 2018, early 19 when we were touring it and doing due diligence. It was one of the cleanest seas I'd ever seen, right next to an opportunity zone, but one that was actually thriving and had the traction and success and international businesses moving there, education, universities, et cetera. So it's Brooks City base on the south end of San Antonio. And a lot of low-hanging fruit. Asset had been held by a family for 35 years. No debt on it. It was part of a portfolio of 6. It's either 6 or 7 properties. Now my memory's not quite clear on that anymore. But we bid on all except for one, the diamond, or the one that they really wanted too much money for. So the reason we were able to even get that property was because we were going after a full 6 apartments, many of them in as great a shape as the one I just described. And somebody else came in, wanted all of the ones that were geographically proximate on the north side of San Antonio, leaving this asset available, and we were able to be the first bite at the apple, and secured in February of 2019 for a little under $7.5 million. Fast forward to today, we've had cash flow around 14% a year. So we distributed throughout the pandemic, 96% occupied. We were almost 98% occupied even during the pandemic, so very stable. Interestingly, a lot of retired military as the tenant base, so older demographic, but very stable, and also does a lot of referrals to fellow retirees and things. So sorry, I'm getting pinged here.
No worries.
Maybe I should figure out how to mute that. There we go. So very, very stable. The other choice we made with that property is to keep the office staff that had been, the leasing manager had been there for also about over 30 years. And that wasn't an easy decision because there was no computers in that office. Ladies didn't know how to use computers and used a paper ledger for their accounting. So it took a while to train them up, and there's still things where we have to rely much more heavily on the regional and the back office of the management company, and let the leasing manager do what she does best, which is the relationships with the residents, because the stability of that property is that leasing manager. She knows the residents, she knows their families, that that community sense of community is so tight. It makes that property a fortress in an area that's rough. All the properties around it are struggling by comparison. I'm going to get to the numbers, which is the interesting part. So fast forward to today, it's valued at least $12.5 million, and we completed a refi for $9 million, remembering that we bought it for a little under 7.5. So we're essentially returning all of the investors' money at this point. And with the refresh on the IO and the lower interest rate, our interest rate's 2.777. Wow. It's basically going to have the same quarterly check size as it did before the refi.
So you end up reducing your debt service because you're resetting the IO, you're getting a lower interest rate, and you're returning all of member capital. Wow. Yeah. That's awesome.
And anecdote, and I don't want to spend too much time on it, but as we signed our first refi app, we got an off-market LOI, pursued that, and then decided, wait, this is a cash flowing asset at a time where we're able to start boosting rents like never before. And if you're in the apartment space right now, particularly in Texas, you know that this summer was just crazy. So we're seeing that. And I made the decision to pull the plug on our we accepted the LOI, which, but I pulled the plug on the sale and said, refi is the way to go on this, because over the next year, the compressed time frame, we can take it to a whole nother level with these rent bumps that we're seeing.
Yeah. I was talking to, you're not the only one to do that. I was talking to somebody that's local to me about an apartment complex that's local to me. And the numbers worked out, and we were about to put in an offer. And right before I did, he said the same thing to me. He's like, you know what? I'm going to refinance this one. It makes more sense to me. I was just like, being on the buy side, that's the last word you want to hear. But I mean, if you guys were cash flowing, 14% every year, and you're able to return all the member capital back and keep up that cash flow, I think it's a no-brainer. I think that's the best decision for the investors and for you all around. But anyway, that said, what's next for you?
So I've got 2 deals I'm working on in Texas, and generally speaking, as my profile, I like to syndicate 2 deals a year and invest passively in 5 to 6 deals a year. So I'm on both sides of the fence. And some would argue, hey, you've got more passive than you do active, but that's a choice, and that ties back to return on time for me.
Yeah, absolutely. And I honestly, that's where I want to get. I'm on both sides of the fence too. I want to get to the point to where everything's on the passive side of the fence, but probably still a couple of years from that, but that's my goal. So That said, let's shift gears a little bit and introduce, Zach Bryan. So Zach, welcome to the show.
Hey, glad to be here, Brian. Thanks a lot for having me on and with such a distinguished guest. It's great reading over your bio, Natalie. It's very impressive.
Yep. Awesome. Well, Zach, why don't you tell us a little bit about yourself?
Yeah, sure. I've been in the Indiana Army National Guard for a little over 17 years now. Looking to finish up that 20 plus and retire from there. Civilian side of life, I work for the federal government for the United States Department of Transportation as a safety investigator. I've been there for about 5 years now. And I've done a number of things in the military that were working with the federal government. One of those jobs was with the U.S. Department or U.S. Drug Enforcement Administration as an intel analyst. And that job kind of really piqued my interest on the analytical side of government work. And then I started kind of developing my taste for real estate and seeing that those two worlds could kind of mesh up a little bit with my interest in hobbies. Educationally, a bachelor's degree in psychology from the University of Southern Indiana, and followed that up with a master's in public service administration from the University of Evansville. Family, married for 17 years, and we have three beautiful children, Olivia, who's 8, Eli, who's 5, and my youngest is 3. So I definitely see family in that return on time that you were speaking about. That's definitely one of my big burning whys.
Awesome. Well, since you brought it up, why don't you just go full into your big burning why? Tell us what that is.
Yeah, great. I see it kind of 3 different reasons all wrapped up into one. First and foremost, generational wealth. Kind of cliche. Everybody kind of tends to say that same cliche generational wealth tidbit there, but definitely like looking at traditional retirement vehicles in IRAs, 401ks, all of the above, seeing how you have to save your way to retirement. That just seemed like a long road to go with possibly not really, making ends meet in the end, possibly depending on your spending habits while you're working. So generationally, I would like to, build a business that's self-sustaining, that gives me assets that cash flow and produce their own income, so they can replace income in older age and not have to be dependent on how much I have saved in another vehicle.
Yep.
That return on time aspect that you spoke about earlier, 3 kids, I'm definitely knee deep in soccer practices, gymnastics, you name it. We're big camping family. We just had a camping trip this past weekend, and we just love that stuff. So, just looking at that longer term, it's only going to get busier. It's never going to really slow down. So I definitely want to build this business out so that it can give me that return on time that can kind of last generations.
Yeah, agree wholeheartedly. Well, here's my favorite part of the show where Zach, I'm going to hand you the mic essentially. So Zach, we got Natalie on the line. What do you want to ask her?
Man, Natalie, where to start? I mean, your resume and your portfolio is so impressive. There's a lot of different ways to go. I'm a guy that works a W-2 job right now. You've had those in your past, and it seems that you've transitioned more to full-time real estate. Can you kind of give me your best advice for when you're time strapped on the W-2 side? What was your best lessons learned to kind of get into multifamily real estate full-time and kind of get over that time hump as I see it?
Yeah. I utilized all my, evenings and weekends. So my first foray or start in apartments was back in 2015. And I didn't go to apartments full time until 2 years later. So 2 years of time I was using all the downtime I could find to meet and interact with people as much as possible in person. Because what you realize with apartments is the transaction, while there's money involved, is really a trust transaction that's happening. So somebody has to trust you, or you have to trust somebody that you're investing with, and it's something that takes time to build. And while I love Zoom and I use Zoom, I don't like it as much as the in-person interaction. I had at least monthly, or probably every couple weeks, even at one point, meetups in Houston, which started, I had 5 people, MBA classmate, fellow apartment investor, come into my first meetup, to gradually filling a room and having to go to a larger space and a larger space. to the point where my last ones before the pandemic in Houston were at the Quest IRA classroom style space, and they're 30, 40, 50 people a time easily, depending on the weekends, or it was Wednesday nights, so depending on when it was. So those in-person interactions, I think a lot of people think, oh, I need a website, but what you're selling if you're a syndicator is, and what people are investing in is you. So you have to put yourself out there, or be vulnerable enough. And for an engineer, which I am an engineer, it's hard to do, but be vulnerable enough to let people get to know you, and let people ask some of the hard questions about how you would handle things. If something went wrong, tell them how you handle it, but communicate, over communicate with people, because your deal, whether it's, syndicating or it's going to happen through and with other people. And the more of those touch points and interactions you can have, the better. And that's really was the longest lead time item, was the people side.
Yeah,
Right.
I agree. Just looking at what's propelled my business forward, it's been mostly interactions with people, meeting other people, finding the right people, hearing just the right thing from other people. Obviously, there's some skills involved as well with underwriting and everything else, but very much a people business. And I agree wholeheartedly. That's probably number one focus is people.
Yeah, you definitely hear that term a lot. This is a team sport, right? Multifamily is a team sport. That's definitely said all around, and I can understand that fully. Could you flesh out a little bit more on the kind of the systems you may use as you kind of brand the Nathalie brand and speak with people? You meet people, but you want to have these ongoing touch points. And I'm kind of thinking from my own perspective here about the Titan Capital Group newsletter. The ongoing updates to my passive investor network. How did you flesh that out, and what did that look like for you?
So I'll confess to not being a burning, shining example of what to do. The reality is I keep in touch, and I'm still very, very old fashioned, where it'll be phone calls and things like that. I get enough newsletters to know that if my passive investors are anything like mine, they don't open or read them anymore. That's the reality. So I haven't done a newsletter, but having done enough, having the momentum, and I know it doesn't help in early syndicated, but once you have the momentum, you have a natural touch point of a monthly interaction with your investors in terms of updating them on a deal and things like that. And then the way I've promoted myself is, again, the old fashioned, keep myself in front of people in person. So what I said earlier. So it's less of a web-based presence with a name and everything else, as opposed to boots on the ground, me. And it's not the fancy answer. I mean, I use systems like Contacts Plus for capturing cards and having scraping the metadata from Facebook, LinkedIn, et cetera, so that the contacts are flushed out. With that information, and when I talk to people, the notes go into that as well, so it's all in one place. So if I'm going to call somebody, I see my history of when I met them, what we've talked about, what their experience is as of the last time I talked to them. So it's organized, but it's a little more one person
Personal.
at a time. Yeah,
Very personal.
And it was easy when it was a couple hundred people in the beginning. And I prided, I was proud of the fact that I knew people's background, and when you get to thousands of people,
It's hard.
it starts blending together, and it's embarrassing. You're like, remind me again, is your spouse in this XYZ field? And they'll say no, it's that, and I have to apologize. But you do try to be personal, because I would want somebody to know me personally and interact with me that way if I was going to be investing with them.
And
so some of it's and a lot of my investors are older too, so that works well with their communication style. They don't want a bunch of emails. They want a say catered service, but they want, if they have a question, they can call, pick up the phone, and bounce it off with me, and I'm available for that.
Now, Natalie, I'll say, I mean, you haven't automated it like a lot of people do, but I bet your close rate's a lot higher if you were to calculate how many people you talk to versus investing. I bet you have a larger percentage of your investor list that's investing as opposed to talk to them once, put them on the distro list and send out the monthly emails. I think the
If
personal approach
somebody
is better.
if you've worked most of your career for the money that you're about to put into an apartment complex, it doesn't get much more personal than that, right? This is your kids' college. This is your retirement. This is a lot of the dreams and things that are on the line, and you, yeah, it is personal.
Yeah, I think especially if you're doing the 506Bs, and you're looking at the non-accredited investor who's investing, that's going to get them, more often than just being thrown on the distro list and getting the weekly or monthly updates and whatnot. So I very much applaud that approach. And I know a lot of people that are doing the same thing. And looking back at who's invested with us, most of them are people we put the time in with, the people who we've been on several calls with. So I don't think I think that's a perfect answer, actually. I mean, no need to apologize whatsoever.
There's always optimizations. Like I do like to think of what could I do better, but I struggled with the newsletter and even, I mean, the need for a website. People that invest aren't investing in a fancy website. Things like that.
And I'm sure once you've had some success, multiple syndications, and you've got repeat investors, I mean, the recipe seems to work. So like you said, optimization is probably more applicable than just getting a massive web presence if what you're doing is already working. So yeah, I appreciate the answer. Thank you.
But it ties into letting people get to know you. So being full, this is my background. This is what I know. This is the role that I'm playing. These are the other things I've done, and laying it all on the table. And one of the things about my meetup that it wasn't always, oh, these are the success stories. We would discuss something that went wrong and then all go to dinner afterwards. And it was just like, okay, and how did that, and what, and the horror stories of apartments, because there's risk involved, right? And people like to see all the sides and feel like they're coming out as a more informed, educated investor.
And at the same time, you probably came across as being very transparent, and very just all cards are on the table, and you let them know the good, the bad, and the ugly. So that probably boded really well for you.
Yeah, and being a passive investor, I know what I would want, right? As an investor, so I view investors as owners in the entity, and if they want information, they're entitled to it. So if it's not part of what we provide in a standard way, getting it to them is part of the asset management job.
Well, great, thank you. I kind of have an asset management question next. As Bryan stated, I'm a general partner on a 68-unit complex in Augusta, Georgia. And so my role in this property has been mostly on an asset management front. I just wondered if you could share some of your most important lessons learned from your experiences as an asset manager.
So how's the deal going?
Deal's going great, honestly.
Okay.
It's performing better than our projections were. We did have to transition out of one property management company into another, and we feel like we're in really good hands. And with any transition, there's a little bit of balls get dropped from month to month, and we're on the upswing. And so things have been going well.
Well, congratulations on handling probably the hardest thing that you can in asset management, which is changing property management. Did you guys close a while ago, or how long have you had it?
February of 2020 is when we closed. Okay. So not terribly. Mm-hmm.
Okay. And is your new management company local or?
They're regional. They do have properties in that area. So we are one of a few properties in that area. Yeah. And actually I misspoke. It was February of 2021. I'm sorry. It was not.
Oh, okay. Okay. So it's a recent deal. And does it have a large CapEx value add?
It was a light CapEx innovation, but it was still pretty significant to our business plan. It was, right around about $500,000 in CapEx, just light unit interior renovations and some exterior upgrading of parking lots and concrete work. And some things, but not an overall heavy lift, I wouldn't say.
Yeah. No, and if it was in February, hopefully, the unit interiors is going to be as people move out, but the other items are either on underway or not. But managing that, what I still look at and ask about on a weekly basis is delinquency and collections, and that's a carryover from COVID, where we're focusing on that has helped keep things tight. Calls are weekly. I'm assuming that's the same case for you. I don't go over everything on every call. I try to prioritize it. On some of them, I do sprint calls with literally just 15 minutes, especially if the deal's going well. And then others can take an hour because we're working through things. But focusing on 3 top priority items. And if you don't already have something like that in place, which a lot of people do, is a weekly KPI report with everything that you need. So while you do see the financials, I hope, or I would ask for access to the property management software systems, so that any reports that you want to pull, operational or financial, you can do that yourself directly. And I do that, and I have that on mine. Normally it's not an issue with the management company. Sometimes they lock you out of part of the functionality, but you just have to go back to them and say, hey, unlock this feature, give me the ability to do that. And in that KPI weekly reporting, what you're wanting to pull together, which you could do yourself, but that's not what you're paying a management company to do it, but you want to look at your forward trend. So you're assessing where things are today with the delinquency and the collections, but you want to know what they're going to be 60 to 90 days out. So because that's what you can influence with the decisions around either pricing and renewals and things like that. So you're trying to assess whether or not you need to ramp up things or slow things down based on what your outlook looks like. So your move in, move outs, notices, the make ready schedule.
Yeah. So I think we've been looking at our renovation budget moving forward, like you're saying, 60, 90, 120, and we're looking at about 48% of our remaining unit turns in the CapEx side of things is going to be happening and occurring in the next 6 months, which is pretty significant for us. So what do you think is a good way to incentivize our PM company to kind of get ahead of that and get a really solid plan so we can, we're looking at needing to hit about 4 to 5 units a month in that time frame. So your idea.
Yeah, how strong is your maintenance person? Because I've lost really good maintenance people this year and had to overpay to get new people in with sign-in bonuses. And I mean, in places like Oklahoma, Texas, I mean, there's for hire signs everywhere. If they can work at Walmart and get a sign-in bonus or McDonald's and get more along with a signing bonus, you've got to compete with that and more. So
yeah, right. So you would say maybe bonuses and just some
if you have a good person, do everything you can to keep them. You can't, especially with a heavy make ready schedule coming, and you can't afford to lose them. Consider supplementing them temporarily. I hate temp agencies. So Texas is an at-will state, so we've got flexibility in terms of hiring, firing. But if you have this surge and the management company doesn't have floating maintenance people that they could assign to your to your payroll temporarily, the other alternative is contracting it out, because you've got to balance the schedule of staying on top of that with the cost, and if the schedule slips, your costs are gonna move up too, because those units are gonna be vacant longer and everything. So you're balancing that. When it's moving fast, things like painting the units and stuff like that, we outsource.
Okay.
Because if we've got to stay on top of work orders on the occupied units, as well as maybe more mechanical type of activity, it's not generally the best return to have our maintenance painting units if it takes a long time. So if you get accrue in, that would be the low hanging fruit of, hey, help you stay on top. I'm assuming paint flooring generally is part of these.
Right.
Flooring is typically always outsourced, but the paint, sometimes you try to keep it in-house. And if it's going to get busy and heavy, that's one I would.
Yeah. One thing we're doing is we're working bonus schedules for the actual property manager, so we've taken our KPI sheet, and a lot of, we've had some issues with management, and a lot of the issues with management is what, Nathalie alluded to is, if you have a really good person, keep them. We've had a high turnover on our on-site maintenance people, especially. So, some of our maintenance timelines have gotten backed up. Some of our value add renovation timelines have gotten backed up. But what we've tried to do is institute a bonus program where the things that matter to us are going to, if they perform the things that matter to us most, they're going to get paid better. And it's just a simple, what matters to us, how can we incentivize that? Now we haven't implemented it yet, so we're hopeful that it works, but that was our solution to try to, keep good people there and to get the things that we want done quickly.
Yeah. I just wanted to add, asset management, you're better off playing defensively in terms of keeping the tenants that are there, renewing them, making sure that they're happy. And if you're going to have the level of turnover that you're going to have, then you have to switch your mindset and go, okay, this is going to be a challenge, but wait, this is our opportunity. We can get into all these units. If you don't have the capital to do that, I would consider going, okay, do we need get the money is basically what, because if you've got that opportunity and the units are coming available, you've got to time crunch it and consider where you can get the funds, a loan or something to bridge and get past that so that you're seizing the opportunity that's there to bring the property to the next level.
All right. Well, we're about out of time, so we're going to finish up with one question to each of you guys.
Well, you can edit it, right?
I can edit it, but I just out of respect of your time, I assume you guys had an hour blocked for it, and looking at the clock, we're banging on that door right now. But
I'll give a little more time. That's fine.
All right. So one last question, Nathalie, you get to go first. How can people learn more about you?
Email me. My email is full last name, DeVosBurchart @gmail.com. On Facebook, it's Nathalie and then my initials DVB. Well, that's the secret to finding me on Facebook. I abbreviated my last name.
All right.
And between those two, that's the best way to get in touch with me.
All right. And we'll put links to the Facebook profile and the email address and the address, if that's okay. Email address in the show notes, if that's okay. And Zach, same question for you. How can listeners learn more about you?
And just like Nathalie said, probably direct email is probably the best. Zachary Bryan @titancapgroup.org. And then as well as just the website. If you come to titancapgroup.org website, you can learn all about our team, the types of properties we're interested in, projects we have ongoing, and you can drop us a line and we'll get back to you.
All right. Sounds great. Well, thank you to both of you for coming on the show today. I appreciate your time and I appreciate the conversation. This was a great episode.
Thank you, Bryan. Thank you, Zachary.
Thank you, Nathalie. Thank you, Bryan.